Okay, welcome back. Nitin Bhasin is head of institutional equities at Ambit. He's now joining us to take some questions on markets. Nitin, good to have you here. Thank you very much for joining us. Give us a sense, give us a flavor of the kind of conversations, Nitin, that you're having with your clients on the buy side, and what is really going on. People are a little bit now in capital preservation mode instead of looking for ideas to make money on an absolute basis. Heavy kind of is that kind of mindset starting to set in this year? Go on.
Hey, thanks for having Prashant on the show. Happy New Year to all of you. The way we are talking to our clients and we are explaining it to them, perhaps after 9 years of a bull run, this year could be a year where the bull run just takes a pause in the Indian stock markets. Perhaps we will go through some sort of a valuation correction. We could go through some earnings moderation. So clearly, what we are advising to our investors, institutional investors in India and abroad, is time to clearly be bracing for some bull run pause. That's one. But within that, asset allocation, stock picking will become a lot more relevant, especially when it comes to choosing between large caps, mid caps, and small caps. We have been highlighting for a while now that it's the large caps which make sense, more so from the way we are seeing the earnings downgrade trajectory picking up or the earnings estimates picking up. It's the large caps where we see sales growth, where we see PAT growth. It's the large caps which are clearly preferred over the mid caps and the small caps. So that would be our key recommendation to investors, institutional or even individuals.
All right. Hi, Nitin. Good afternoon and good to see you in after a very, very long time. Since you briefly mentioned on earnings, and we have tech earnings that will come in the next 60 minutes or so, kickstarts with TCS. The fear is there is a downside to the earnings risk. And then India shouldn't be trading at such a peak multiples. Though you'll argue that for the last 6 months, we haven't done anything. Time-wise correction has happened. And also earnings estimates have been pulled back. Do you believe there is still more downside to earnings estimates and the street is sounding too optimistic? For FY26, everyone's talking about at least mid-teens, early to mid-teens earnings growth. Is there a risk out there?
So Nigel, if you take a little longer perspective over the last decade or so, Indian earnings every year prior to COVID used to see through a huge moderation from the time we began the year to ended the year from our community of the sell side. But COVID and post-COVID, about 2 or 3 years, we've seen that the earnings were pretty much sustaining to what we had in the beginning of the year. But this year, we've already seen that Nifty earnings could be more towards closer to about 8-9% or perhaps even lower. And a lot of those earnings are being supported by the banks sector. And I think perhaps the same thing will play out next year also. It's the IT which drew some bit of earnings growth this year after banks, and next year again banks are supporting most of the earnings growth. So clearly what we are more fearing is that in the second half of this fiscal, would there be more moderation in the non-banks earnings of the Nifty or the broader market? So we see risks. If you look at the Q2 numbers that came out, if you look at, hence this quarter becomes even more relevant for people to gauge the direction of earnings. There is a risk to the earnings. We all start at mid-teens earnings growth for next year. I would be in the camp of lower teens, perhaps next year. That could be coming in from what we see at macro and little reasons for margin expansions available in the country. So hence, I would say we will be more closer to 8-9% or even lower than that in India this year for Nifty, and more towards lower teens next year.
Okay, 8-9% for this year and lower teens next year. Got that, Nitin. Thank you very much for being with us on the show today. So in that, cautious construct, let's talk about, what your top overweights are and what you're staying away from. And we have some snippets from your coffee can portfolio where we'll just put this up on the screen as well. HDFC Bank is a buy. HCL Tech, LTI Mindtree are 2 sells from the IT space. Avenue Supermarts is a sell. Even Dixon, Dixon has been such a high flyer of 2024. That is a sell at this point in time. These are some of the first few names. The others are flashing on the screen. So just take us through the thought and the construct on what you will keep in the coffee can and what deserves to go out now.
So thanks a lot for this. The coffee can report that we put out is more like for people who can actually build portfolios and own good quality companies, using certain financial metrics, just can buy those stocks and just sleep over them for the next 5 years or 7 years or so to make, classic buy and hold strategy. But many of the institutional investors perhaps are not able to or cannot follow that as a strategy. So hence, how we look at the next 3 months, 6 months, or the next 1 year more so today, we would be more constructive or overweight on IT. We would be more constructive or overweight on banks. That's where we see the earnings are. That's where we see the quality perception is. 2 or 3 months back, when we had put out this note on the market, which we still believe today is valid as well, is that quality, low volatility, and earnings revisions are being favored by the market. Earnings revisions to the positive. So the way we look at it is quality. IT sector forms the second highest sector in the quality factor indices in India. So banks as well as IT would be our top recommendations. And within the IT sector, perhaps we would recommend, given the valuations and the near-term earning risks, as our analysts suggest, we would prefer more like turnaround plays like a TechM, a Cyient, or a KPIT. Those are the ones preferred for us for the next 1 year. That's how we would actually recommend in IT. Whereas, as you mentioned, there's 2 sectors overweight, banks and IT.
Right. Nitin, just clarification. We have that coffee can portfolio in the list of stocks there. Some of them are rated basically no rating. So you have coverage on these names, or these are?
So we have a view on those companies, and we don't presently cover them very actively. But and these are for investors again with a 5 to 7 year holding. So it's been about 14 or 15 years. We as an organization have conceptualized this thinking, which has been there for years in the investing industry, about buy and hold. And coffee can is a way for us to search stocks which have done very good over the last 5 to 10 years, which investors should think about, irrespective of valuations, to create long-term portfolios. These are the companies that come across today, but they are more from 5 and 7 years of holding horizon, whereas a market view could be for about 3 months to 12 months also.
Okay, so let's talk about the year end now then, Nitin. Clearly, looking at earnings, looking at the consumption feedback that we get, something needs to be done. But what is that? What would be on your wish list? From the government of India, what do you expect? And from the RBI, rates have stayed high. We haven't seen a rate cut, I think, for around 700 days. That's as per the Bernstein report that we were talking about yesterday. So clearly, there are some rate cuts as well that the market wants to see, because by itself, it's downhill. Like we've been seeing that for the last few months, in fact, that things have been getting a weakish. So what's on your wish list from the government, from the RBI?
I'll take government first. I think the talk of the town, everybody is talking about consumption and job creation. I think job creation should be the first agenda on the minds of the government right now. And there's both supply and demand things that need to get solved. Clearly, one of the recommendations, not very easy for the government to actually follow, may not be very much going well with the industry, but otherwise it has to be the relook at the entire minimum wages in India. Perhaps even one can see how the inflation is hitting the bottom of the pyramid, the rural wages, etc. The real wage growth for rural market hasn't increased. So I would say relook at minimum wages in India. That creates the incentive for people from the farmland to actually move into the factories. Availability of labor improves. Consumption at that element also kicks. I think from other side, I would like to see the government reduce a lot more pressures of legislation, clearances, etc., for the capex to pick up in India from the private sector. Private sector can actually say that we don't see a strong trend of consumption or visibility of demand. But if we were to actually fast pace and reduce the cost of creating capacity by giving land faster, clearances much faster, reducing legislation, perhaps it solves both corporate capex as well as, to some extent, the FDI and the ease of doing business in India. I would say those will be the first and the second. And I think not overlooking at the fiscal deficit in India, though we are thinking about the budget will be more like status quo at about 4.5% sort of fiscal deficit. But without thinking too much about that, how the government announces capacity creation in state and center to catapult the hard infra capex to grow more like low teens to mid-teens in both roads and railways after a sort of weak FY25 on the capex growth. I would say that those would be my three wishes from the government of India. And RBI, I would say from the RBI, it'd be very tough for the new governor, a very balancing act, how they would actually look at the rate cuts. The disinflation towards the fag end is becoming very sticky right now. So very early days to form a view that a rate cut is coming. Our view is 25 to 50 bips, more like a 25 bips, very difficult to take a rate cut in the near term for the markets if they're expecting some. RBI will find it very difficult.
It's a catch-22 because inflation hasn't shown signs of sort of persistently declining, and that's the big conundrum. But just to go back to that point on IT and banks, then I was curious because the bears there are going to say that why buy banks now? The narrative is that credit costs will probably start rising when the best of asset quality is behind us. People are arguing that margins may not expand, may even come under pressure as rate cuts start happening. Then there is this whole fight for deposits that's going on. So why are you positive on banks? And similarly for IT, we were just having this discussion before you joined us that at least the larger firms, we're talking very anemic, 4-5% growth in a year. So what makes you bullish?
So, we all believe that markets, as I was mentioning in the beginning, we are expecting in the second half, the Nifty earnings, non-bank, under more pressure, and perhaps the risk of more downgrades over there, whether it is capital goods companies or whether that is auto companies or whether that is FMCG companies, you name. Other sectors have a more risk because they're all sitting on expectations which are very high. Banks that way have a little less exposure to the cuts over there, perhaps earnings downgrades. That's number one. Number two, if you were to think about it at larger level in India, whereas there is a valuation comfort, banks as a sector is about accounting for closer to 25-26% of aggregate PAT in India, with perhaps a market cap much lower number than that, more closer to 14-15%. So on that aggregate profitability theory, I would say banks look the most undervalued. But another factor I'll throw in over here for everybody to appreciate is we are in the last 5 years looking at one of the most non-concentrated markets. Unlike the US, in our country, we have perhaps one of the lowest concentration of, let's say, top 10, top 20, top 50, top 100 in the overall markets, market capitalization right now. So we see that in the times to come, where the earnings are becoming more riskier for smaller weightage companies, mid caps and small caps, the money will start finding itself to stay where valuations are reasonable, where profits are going to be less prone to cuts, or estimates are less prone to cuts relative to the other market. So relatively, banks will become that place of mega caps where market might gravitate towards in the times to come. And as we move away from massively non-concentrated, fragmented market capitalization concentration to more concentrated markets, you will see mega caps like banks, some of the other companies do really well. So that could be my thinking, that aggregate profitability, more risks of downgrades in the other sectors makes bank relatively a better place to be in right now. IT, clearly when we are looking at downgrade risks in the marketplace, the same theory relative to the other sectors. What is perceived as quality? FMCG is perceived as quality and IT is perceived as quality. So that factor of quality factor, we foresee market rotating towards those companies where less risk of earnings cuts and are thought of as quality businesses. That's where the IT would be. So hence, that's where I would say banks and IT become our larger ideas among the sectors. Otherwise, it's a stock picker market this year.
Absolutely. Got it, Nitin. Thanks for joining in. It's been a while. Good to see you, Vin, and looking forward to chatting up with you all through 2025. Appreciate you joining in as always.